Well, hello everybody. Thanks for watching this video. This video is going to be a brief survey of various technical indicators. Technical indicators are used in technical analysis as opposed to fundamental analysis. So technical analysis in a nutshell and indicators are some calculation of time, volume, and price in order to plot some kind of data on your chart, which is then used to interpret what the market is doing. Generally speaking, you're using indicators to identify either the continuation of a trend or the beginning of a new trend, which would basically be the reversal of an existing trend. Okay, there are literally hundreds of different technical indicators out there. You can lump them into some major categories. I'm not going to go over every technical indicator. I'm going to go over some of the most popular ones. One thing that's really important to understand is that there is no perfect indicator. Very few successful traders use only one indicator. They will use more than one indicator. Not all indicators work in every situation. The other thing is that technical indicators do not predict anything because they are using past information, so they cannot predict anything. There is no way to take past information and predict what's going to happen in the future. The best that technical indicators can do is to project the future, to take a look at what the technical indicator is telling you on the chart in order to identify a high probability setup. In other words, a setup that has a high probability of being profitable or successful. Another way to put it is a setup that has a high probability of moving in your desired direction, whether it's up or down. If you're shorting, you want it to move down. If you're going long a position, you want it to go up. In the case of options, where you're depending upon a time value decay in order to profit, you're going to be wanting a technical indicator to tell you that the market has a high probability of moving sideways as opposed to up or down, that you're in a basically area of price congestion. Okay. When I say that you need more than one technical indicator, a lot of traders, and this is something that I do, is I will use some indicator to identify a potential setup and then another indicator to confirm that setup. Sometimes for me it may be the same indicator just over different time frames, or it can be a combination of two or more different technical indicators. Sometimes I will use one type of technical indicator as an entry signal and a different type of technical indicator as an exit signal, although you can use the same combination of indicators for exit and entry if that's what's comfortable for you. The purpose of this video is really just to show you the different indicators that are out there and give you a brief kind of familiarity or comfort level with them. At the end of the day, I think it's important for you to develop your own trading system and to experiment with these technical indicators, whether you're using some kind of paper trading platform or what have you, to experiment them and see what works for you. On a side note, there's all kinds of trading systems out there that you can pay money for. I think most of them are a waste of money because they may very well be a trading system that works for the person that's selling it, but it's not necessarily going to work for you. And if it's not going to work for you, if you're not comfortable with it, you're probably just wasting your money. The other thing is, if you have a system on your own that you develop, you have more confidence in it and you're vested in it. So I think for you it's more likely to be successful. So don't think that you're going to come out of this video with the perfect set of indicators for you to put on your charts in order to trade successfully. I got bad news for you. You're going to have to play with them and experiment with them and like I said, find out what works for you. So the first set of indicators I'm going to talk about, and you can see it on this chart here, are moving averages. Moving averages are the simplest of indicators. All they really do is the plot line, which is, so for example, this white plot line here is a 9-period moving indicator. Moving averages take price, and it can be a closing price, it can be an opening price, it can be a high, a low, it can be an average of any combination of those. I tend to use closing price because I wait for a bar to close before I make a move. So I use closing prices. Some traders might argue with me on that. They may use opening prices or some average. All I'm telling you is what works for me. Just it's important for you to know that those options are available to you. It takes, in this case, closing price, and it averages it over a certain number of periods. So in this case, I told you this is a 9-period moving average. So if this were a day chart, it would be the moving average of closing prices over 9 days. The less number of periods that go into that moving average, the faster and more responsive it's going to be. The more periods that go into a moving average, the slower and less responsive it's going to be. Now there are some trade-offs. The faster an indicator is, it's going to allow you to respond more quickly, but you also tend to get whipsawed a lot more than you would if you were using a slower indicator. Problem with the slower indicator is it's going to take a little bit longer for you to actually get the signal, but when you do, it tends to be a more reliable signal. So some traders, and I'm one of them, use use multiple indicators on a chart. Some of them are fast, some of them are slow. Now, there are several different types of indicators. I'm not going to go into a lot of detail here. I'm going to do a separate video on that's really just in-depth on moving averages. There's a simple moving average, which is basically just, if it's a 9-period moving average, then it takes the closing price of those 9 periods. If it's an exponential, it more heavily weights recent closing prices. Okay. If it is a weighted indicator, then there's some weighting scheme that goes into it. There's a Hull indicator and there's a Wilder's indicator. The Hull indicator applies the weighted moving average in order to smooth the data out. So that creates, some kind of a lagging effect. The Wilder's indicator uses a smoothing factor, which is 1 divided by the length of that indicator. That's the smoothing factor that goes into kind of smoothing out that indicator. Like I said, I'm not going to go into a lot of depth on these different types. It's just important to understand that they're there. I'll have a different video that will go into more detail about the types. I personally use the Wilder's because for me it tends to be the most reliable. It whipsaws you a lot less than your simples or your exponentials. Okay. Now, like I said, there's fast versus slow indicators, and one of the things that's important about fast versus slow indicators is that they can be used to identify or confirm trend changes. So in this example that I've got right here, remember the white indicator is the 9-period moving average, and this red indicator here is the 27-period moving average. Okay, so it's more periods going in there, so therefore it is slower. Now you can see here that the 9 and the 27 are very close together. And you can also see here that the 9 is starting to pull away from the 27. So what is that? That's an indicator of downward momentum. You could use that as a signal that a downward trend is starting. So some traders use a pull away like that as an entry signal or as an exit signal. You can also use crossovers. So here you can see that this faster moving average started to cross over the slower moving average, and it took some time for that to happen. There was some whipsawing here, but eventually it did trade down. Now the problem with crossovers is a lot of times there can be fake outs. You can get whipsawed. You can have one moving average cross another, only in the next bar to have it cross back above. So you're going to have potentially you can have some whipsawing there. Now you can also pick a moving average and then say when the price crosses above or below that moving average, that's going to be my entry or exit signal. A lot of times, especially when it comes to the indices, you'll hear, oh, the Dow Jones Industrial Average crossed below its 200-day moving average. That's a bearish signal. So that's an example of using the price crossover as an indicator. You can also use crossovers of indicators themselves. So if you have a fast indicator that crosses over a slower indicator, that can be a signal to either go long or short depending upon what direction the cross is going in. There's something called the golden cross and the death cross, which is, depending on who you talk to, it's either the crossover of the 20 period across the 50 period. So golden cross if it crosses above, death cross if it crosses below. I've also heard of some people that use a 20 and a 200 or a 50 and a 200. So again, there's all kinds of different things out there. Get it, what works for you. The point here is that crossovers of moving averages can also be used as indicators, as buy or sell signals, as entry or exit indicators. Okay. So we talked about using indicators as a trend change signal or a trend continuation signal. So a lot of times when there's a crossover, that's an indicator that a signal is about to change, it's about to reverse. When you see a pull away like this, that's more of a signal that the trend is continuing. So for as long as this faster average continues to pull away from the slower average, that trend is continuing. If the space between those two indicators was to stop increasing and start decreasing, that could be taken as an indicator that the trend is now about to reverse, or at least it's slowing down. Okay. Again, you're not going to get they don't have predictive value, they have projective value. Okay. So that's pretty much it for this discussion of moving averages. I think I've hit all the points I want to hit here. The next set of indicators that we're going to talk about are momentum indicators, and you might have heard of some of these. There's MACD, which is moving average convergence divergence, which is the one that we're going to talk about in this cell. There are stochastics, which we're going to talk about in the next cell, and then there's indicators of relative strength. Williams percent R and the RSI, or the relative strength indicator, are the ones I'm going to talk about here. But the point is that all these indicators are indicators of momentum. Okay. The first one I'm talking about here is MACD, and MACD basically has two lines, and again, there's a fast signal line and a slow signal line. I'm not going to go into the technical details of how these lines are calculated. That's a discussion for a more in-depth video. But the point is that in this case, and the defaults may be different on your trading platform, but check the technical specs of the MACD on your platform to find out which is which. But in this case, the light blue is the fast indicator, and the yellow, the light yellow, is the slow indicator. Now I have a version of the MACD that also has a histogram on it, and we're going to talk about that in a second. But basically, when you see a crossover here of the fast plot below the slow in this case, you would take that as a sell signal, or a trader might take that as a sell signal. Okay. Now, corresponding to that, you can see the histogram here, which measures the difference between the fast and the slow indicator, can also be used as a handy indicator to tell you when there is a trend change. So in this case, the histogram crosses below this zero line here, which is this purple horizontal line. One of the things that I find in my experience is that these crossovers are stronger when they occur above or below the line. What I mean by that is, in this case, this fast signal crossed below the slow signal, which is a sell indicator, but it's coming out of a position where it's above the zero line. So another way to put that would be that particular security is oversold. Okay. I think that if this short indicator occurred below the zero line, that would either be less reliable, less durable, which by durable I mean it's going to last over time, or not going to be as strong of a move, or a weaker move. Now you can see that in this case, it didn't necessarily play out that way. I mean, this occurred way up here, way up high. The crossover occurred relatively high, but there was a lot of whipsawing action here. Okay, versus this, in this case, it did occur below the zero line, but the crossover happened right about here, and you can see, oh, I just zoomed in, which I didn't mean to do. You can see that this was a pretty strong and sustained move upward. So when I say that they tend to be better when they're either coming out of an overbought or oversold position, by that I mean in general. Again, nothing happens 100% of the time. Okay, this has just been my experience, is that the crossover tends to be a stronger signal when if it's a signal of potential weakness. It's stronger if it comes out of previous strength. You may have heard buy on weakness, sell on strength. So the best time to sell, which is, when you're closing a long position, is when that price action to the upside is very strong. You don't want to miss a lot of the upside, but once that starts slowing down, it's too late to get out. You might give back a lot of profit. So that's kind of the theory behind that. So that is pretty much the discussion on MACD. Again, the key points: fast signal, slow signal. The crossover is what you use as buy or sell indicators, and the histogram is what measures the difference between those two indicators. All right? As that histogram increases, as you can see here, that is a sign of strong upward momentum. And as the histogram decreases, and if those bars continue to get larger on an absolute basis, that means that you're in a strong downtrend. So you can see that there's a lot of nuances to how you use the MACD. You can use it to identify not only trend changes, but also trend continuations and relative strength of those, trends. The next indicator that we're going to talk about, and this is my favorite. I use stochastics a lot in my trading, my swing trades as well as my day trades. Again, stochastics are comprised of a slow signal and a fast signal. So in this case, my fast signal is the red line, or I'm sorry, my fast signal is the green line, and my slow signal is the red line. So the fast line is an average, the slow line is an average of an average, and that's all I'm going to say. I'm not going to go in depth. That's a video for a different time. That's beyond the scope of this video. Now, the thing that's different about the stochastic is that there is also an overbought level and an oversold level. So anything above 80 is considered overbought, which means that it's time to sell, either sell to open or sell to close. And an oversold position tells you it's time to buy to open or buy to close if you're short. Okay. Again, in this case, there's a histogram, which is a different indicator on my platform. So the histogram represents the difference between these two signal lines, or these two plots, and as those bars get bigger on an absolute basis, that is indicating a strengthening of said trend, whether it's up or down. Now, I use the histogram crossover of 0 as a potential signal entry point. You could also use it as an exit point. I don't like to do that because in my experiences with stochastics in particular, if I were to wait, like if I go short here and then I go short and I hold on to it until I get an up arrow, that means I've usually given back most, if not all, of my profit. So I like to use some other indicator as my exit signal. So I use it as an entry signal only. I do not use it as an exit signal. One way to use it would be when this fast signal crosses below overbought level, which is 80 in this case. And you can adjust this if you want it to be 70, you can do 70. 80. The default on my platform is 80 and 20. 80 overbought, 20 oversold. So when the fast signal line crosses below 80, you could say that's a signal to go short. All right. I have done that. Be prepared to get whipsawed, because it's not at all uncommon to see this fast signal cross below and then whip right back up again. Now, one of the things I do to kind of help prevent me getting whipsawed is I might look at that same indicator on a different time frame. So if I'm on a 15-minute chart here, I might have right next to it a 5-minute chart. And if I'm looking at the 15-minute chart, if that's where the chart I look to get my entry signals, then I might take a look at the 5-minute chart to see if the fast signal has continued to go down. If I see that, that might be my confirmation that I'm probably not going to get whipsawed. At least I hope. Now, again, nothing's true 100% of the time. Generally speaking, and this has been my experience, when you see a crossover and this fast signal is moving towards oversold, that move is usually not done until the slow signal also touches down. And I shouldn't say usually, I should say the majority of the time, that move is not done until the slow signal has had a chance to move all the way down to oversold. Now again, nothing's true 100% of the time. I would recommend using some kind of confirming factor, whether it's that same indicator on a different chart, like a different time chart, or some other indicator altogether. Okay? All I'm telling you is that that's what my experience has been. So if I'm using an indicator crossover, which is the fast signal has crossed below the slow signal, which is indicated by a crossover of the histogram here, that's my signal to go short. Okay, which is generally what I do. Now I wait till that bar closes. I have traded before the bar closed when I'm confident that it's going to close that way, but I have had some times where the bar closes and it actually closed above. You know, it didn't confirm, it didn't continue, and I wound up getting whipsawed and stopped out of the trade. So that's why I like to wait for this bar to close. I think that I've gone into enough detail here on stochastics. I'm going to move on to the next indicator, which are the indicators that tell you if something's overbought and oversold. And here's two examples, the Williams %R and the RSI. I'm not going to go into the technical details about how these are calculated. Again, that's going to be a more in-depth video. But the bottom line is that you've got your signal line here, okay, which is blue on the Williams and gray on the RSI. As the signal line crosses above, in the case of Williams, it's -20 or 80, or in the case of RSI, it's above 70 or below 30. But when it crosses above the overbought level, then that is a signal that the trend is about to reverse. In other words, the trend to the upside, the increases in price are slowing down and are about to reverse. Now you can see it is possible to get whipsawed. You know, here Williams %R crossed above and price continued to go up. And even though Williams crossed below, it then went down for a little bit, but then it reversed and it started to go up. So maybe having some moving averages on the same chart might help you in this case as a confirming indicator. And you know, RSI had the same problem. I mean, no one's better than the other. You know, in this case, this RSI appears to be a slower indicator. The Williams is being calculated over 10 periods, and the RSI is being calculated over 14 periods. So this one is a little bit slower, and the reason why I can say that is because during this time you see a lot of crossovers above and below overbought, but there are no crossovers here on the RSI, which you might take to mean, well, then that means the RSI is a little bit more of a reliable indicator. And you could argue that. I mean, in this case, you know, RSI is headed in an upward direction. and it continued to go up until it crossed into overbought, and then started to reverse, as opposed to here on the Williams, it crossed into overbought all the way back here, and if you had chosen that as a signal to get out, you would have missed all this upside. Okay, so that doesn't mean the RSI is better than Williams. Okay, they just have, every indicator has certain advantages and disadvantages, and like I said, one of those things is, fast signals are more sensitive, so you catch trend changes sooner, but because they're more sensitive, they also can change more quickly, and you can get whipsawed. Excuse me, there's going to be a lot of false signals. So a lot of that depends really just upon how you trade, your style of trade. So again, the quick sum up on, indicators of relative strength that tell you when something is overbought and oversold. You have a plot line, which calculates some average, presumably, over a period of time, and when that signal line crosses above or below, those can be taken as signals to exit a position or enter a position. So a crossover above for a Williams R might be, if I'm long, then it's maybe you might say that's time for me to get out because momentum it's getting to an oversold condition. Another thing that you might do is, okay, when the slope of it changes, so as long as the slope of that signal line continues to go up, I'm going to stay long. But as soon as it pulls back and I get confirmation in that next bar, then that tells me that price momentum has changed and it's time for me to exit my position. And I might not actually enter a short position. Again, this is just how you could use it. I might not potentially enter a short position until that signal line crosses below overbought, this 80 level or this negative 20 level in the case of Williams, and then confirms. Okay, so those are the that's what these indicators do. You can see what the similarities are between Williams and RSI, but there are also some differences too. Now, a lot of these parameters, can be changed in your platform. The default depends upon your platform. I can tell you what the default is for me, and by default I mean the colors that are used for your plot lines, and the specific parameters that go in there. So over how many periods is it calculated, and what is the overbought and oversold level. Next, we're going to go on and talk about market profile indicators. And market profile indicators, there's two different types. There's a volume and there's a time. Now, some traders will tell you that one's better than the other. Okay, so let me start with volume. These blue bars that you see here represent the number of contracts traded in the case of the crude oil futures, and the larger that the bar is, the more volume that occurred at that price level. The upper bound here and the lower bound here, so anything between these two levels is where 70% of the volume traded. Now again, that's a parameter that can change. You can change it to have it be 80%. But what this is telling you is that 70% of the volume on this particular trading day, because this is a 15-minute increments on one single trading day, but 70% of the volume occurred between these two lines. The area between these two lines is called your value area. The reason why it's called a value area is that is where traders see fair value. Okay, that's where they agree upon the range at which fair value occurs. Generally speaking, if your price is below the value area, you can expect that it's going to be drawn upwards to trade back into the value area. Vice versa, if it trades above the value area, you can expect that gravity is going to kick in. There's such a thing as gravity in the market. When things get too overextended to the upside or the downside, there's a tendency to revert to the mean eventually. So when you trade too far above value area, you can expect at some point in time that price is going to be drawn back into value area. Now you see this red bar here. This is the point of control. Okay, point of control is where most of the volume is the area where most of the volume has traded. So this is the single largest bar of all of these volume bars plotted here on this graph. Okay, that's the basics of volume profile. Now there's also a time profile, and on this particular platform, instead of having bars, you have numbers. Some indicators use letters instead of numbers, but the point is that these represent periods of the day. Okay, so for example, what you see here, you see 0, 0, 0. That's the very first period of the day. Then it moves on to 1, to 2, to 3, and so on. So you know that this particular contract, which is the S&P mini S&P futures, traded at this price level, this price level, and this price level in the 0 period. Okay, if that makes any sense. But again, it's a time period. Now, the point of control is defined by the price level at which the contract traded during the most number of periods. So another way to say that would be the price level at which that particular security spent most time trading. Okay? This particular indicator right now is defined to also have the volume. So this is the volume profile superimposed right next to it. Sometimes you'll see, in fact, oftentimes you'll see a disparity between where the volume point of control is and the time point of control. All right? Depending upon your personal opinion, you know, what do you think is most important? The price at which it traded the most volume, or the price at which it spent the most time? You know, which one is a stronger indicator? Okay. Now, one thing I will tell you, that's a subject of debate amongst traders, but one thing I will tell you is that if you see the volume point of control and the time point of control line up, then that confirms that that is a very strong point of control. And the reason why being a point of control is a pivot point, all right? Generally speaking, it is difficult, especially when a point of control is very strong, it is difficult for your price to cross back above or below. So in this case, price spent most of its time below the point of control here, okay? And you can see that, you know, with all of these trades here. Generally speaking, if price were to have turned up, it would be difficult for it to cross the point of control, and if it does, it's going to be difficult for it to continue to move further above the point of control. That's how you use a point of control when you're trading. All right. Now, some traders might take a look at this reversal back into the value area, and they might say, well, there's a very strong chance that this security is going to trend back towards point of control. Now, in this case, it didn't happen, but a lot of traders would take a look at that if they happen to be in this bar, might take a look at that and say, my projection, not prediction, again, because these things don't predict anything, but my projection is that since the mini S&P futures are moving back up towards the point of control, that the probability is greater that it's going to continue to move there until it hits that point of control. Now, one other point that I'll make here is that higher areas of volume and higher areas of time tend to act magnetically on price action. And what I mean by that is that price has the tendency to move towards where the greater volume occurred. Okay. Now it's one thing when you're in the middle of the trading day and you're seeing this actually draw in real time on your chart. Now I'm doing this video on the weekend, so these are very static because the markets are all closed. So you're not going to see that. But when I do a more in-depth video on using these market profiles, I will do it during a trading day so that you can see how you can utilize a developing profile plot to help you with your trading decisions. But for right now, we're going to talk about just static time profiles and volume profiles. So again, to sum up, the value area is where 70 or 80%, depending upon your platform or what your personal preference is, but where the vast majority of volume occurs, or the price level at which the security spent the vast majority of its time trading. Okay, again, two different things, and I'm not going to weigh in on the debate of which is more, which is more meaningful, time spent at a price level or volume transacted at a particular price level. If I had to tell you, I'd say probably use both, because remember what I was saying about sometimes you use, you don't want to use any one indicator. Well, you might use time as your primary indicator, but you're going to use volume as you're confirming, or vice versa. Okay, and again, when there's a disparity between what your volume point of control is and your time point of control, those points of control are not as strong as they are when the actual points of control line up. And one thing that we can do here is kind of zoom in, if I can find a price level where that occurred, or a day where that occurred. On this particular day, the volume point of control and the time point of control were identical. And you can see that the security traded most of the day around both points of control until later in the day something happened. Some outside force acted upon price action and it pushed the mini S&P futures down towards the close. All right? But the point is that because these two were lined up, it acted as a stronger point of control, and the particular security spent not only most of its volume at that price level, but also most of its time at that price level. And you can see the strength here, okay, versus if you, forward to a different trading day where there was a disparity. All right, here there's a disparity between volume and time, and really this security didn't really spend a lot of time at either end. Probably more so on the time, because specifically that you're looking at time, but there was a lot more deviation away from that point of control throughout the course of the trading day. All right, so that's pretty much that the discussion when it comes to market profile indicators. The next thing I'm going to talk about is volatility indicators, and the two I'm going to talk about are average true range and Bollinger Bands, and they're both here on the same chart. Now, Bollinger Bands are almost like an area of trading. You have a moving average, which in this case I think this is the 27-period moving average, and then you have signal or boundary lines on either side of it, which are 1, 2, or 3 standard deviations away, up or down. So -1, +1, 2 or 3 standard deviations away from that moving average. Now, when you have an area where your Bollinger Bands are narrow, your security tends to be very range bound. As you can see here, as the bands start to widen, that is an indication of greater volatility. So greater price ranges is what that really boils down to. But also in this case, you can see that as the Bollinger Bands start to widen, the security in particular tends tends to trade to the downside, and it's pushing this Bollinger Band out. Now, there are some practitioners that will tell you, or the way that they trade is, as soon as price hits the Bollinger Band, I close my position. I don't trade that way. If I see that Bollinger Bands are in a widening phase, I take the touch of the price to the Bollinger Band as a buy signal, because usually when those bands widen, the trend tends to continue. Now, in this case, it touched, but then it reversed, so I would have been whipsawed out of this trade, and I can see that it crossed below this moving average. Now, that cross below the moving average could have been taken as a signal to open a short position, but you can see that that might not have been wise, because you would have gotten whipsawed back up here. So I might say that, okay, well, I placed my stop above that moving average, because that, if it crosses back above, then that tells me that I'm wrong. But it could conceivably cross above and then cross back below if you're in a very volatile environment. So again, 100% of the time these things are not reliable, but the majority of the time they are. And at the end, if you've watched my videos, you've seen me talk about, how important calculating probability is, and calculating a risk reward. So if you have basically a coin flip, if you're in a situation where price moving up or price moving down, there's a 50-50 chance of it happening. If you pick someone that's got a 1-to-1 risk-reward ratio, you're not over time going to do better than a coin flip. You're going to basically theoretically break even. Now, the problem with that is, unless you're trading on a free platform, you're going to wind up losing in the long run, because don't forget, you've got transaction costs. So that's an aside that we don't really need to go into. But the point is, with all these indicators, that you want to use it as some kind of an indicator that tells you this is a higher probability or high probability setup, because again, it's not a predictor. So some traders use a touch of the Bollinger Bands as an indicator it's time to close out, because this upward trend has now ceased, which in fact it did, but then it moved down. Now, price here touched the Bollinger Band. Now, if you had used that as your signal to close your position, to exit your position, you might have done well, because if you opened your short position here, or even when it crossed the moving average, you traded all the way down to here before you closed your position. On the other hand, you also gave up a lot of upside. Okay, so some traders might not want to use the Bollinger Bands as a entry signal. They might want to use it instead as a confirmation signal. So in other words, let's say I'm using RSI, and RSI told me here that this is now oversold because the RSI crossed above 70. Then I might use that as my heads up that there's about to be a trend reversal, and then use this widening of the Bollinger Bands as my confirmation that this trend is continuing to the downside. Again, very nuanced, and technical analysis can be very nuanced. A lot of those nuances are way beyond the scope of this video, because again, this is just a survey. But it's important to understand that there's a lot of information packed in here, and different traders use the information they're presented with differently. And again, you have to use these indicators in a manner that suits your particular style, and the best way to figure that out is to just play with all of them. And don't make a trade with real money. Use a paper money platform, or just sit there and observe. And if you sit there and observe how these indicators interact with the price of the security in question, you can use it to start to get a feel for what the market is doing. And the best traders, or the most successful traders, tend to be people who trade when they are in the zone, when they really understand the momentum of the markets, and they really understand these technical indicators and how they work, and they have confidence in the technical indicators, and they also have knowledge of those technical indicators' shortcomings, so that they know when the indicator can fail them and they can get out and cut their losses before the losses get too large. Those traders tend to be the most successful because they are now in tune with the motion of the market. And oftentimes I refer to the market as, like, I'm a very visual person, and you can see motion here. You know, you can see ups and downs, you know, here, like the waves of the ocean, where it's very, you know, very even. It chops back and forth a lot because you're range bound between these two Bollinger Bands. But then some outside force acts upon it, and it starts pushing it down, and now those bands widen, and you're seeing gravity kick in, and you're seeing momentum or motion to the downside. And then you see this reversal here. And the reversal here is confirmed here by a reversal in the direction of the lower Bollinger Band. All right. So that's the conversation on Bollinger Bands. The next one is ATR, average true range. Average true range basically tells you what is the average of the range at which this security is trading over a defined period of time. Okay. Here we're using 14 periods as the input for how we calculate our average. The importance of what the actual number is really only important when some people use ATR to calculate stops. So they might say, the trader might say, okay, if the ATR here is 6, that means that it's going to be, you know, on average it's moving up or down, you know, 6 thousandths, which, you know, these are the copper futures. So your ticks are measured in, you know, thousandths of a percentage point. Okay, you can see it here in this case. This is 2 and, you know, 2.9765, right? So the 10, the 10th, the 100th, and the 1000th, and then this is the 10,000th, right? So this is telling you that your price range is 6.5 thousandths. Okay, so if you use the ATR to calculate your stop, I've heard 3, 3.5, or 5 as your multiplier. So in this case, and let's not work with thousandths, let's do something that's a little bit easier, which is the mini Dow futures, because those, you know, your tick is measured by a single point. So 23,586 is one tick away from 23,587 and 23,585. So in this case, if your ATR is 92, right? 92 actual points, all right? On this particular day, that was, you know, kind of a volatile day. Now, you might not look at it on the 15-minute chart. You might use your 15-minute chart to trade, but because you can see over the course of the day, this changes so much, so it's not going to really have a lot of utility for figuring out what is your ATR that you're going to use as stops, because you're going to be recalculating this multiple times a day. You might instead take a look at the day chart. Say, okay, well, over the day chart, like yesterday, the ATR was 478. Okay, now again, that was calculated over a period of 14 days. So, you know, not necessarily going to have a lot of utility when it comes to calculating. If you say, I'm going to take 478 and multiply it by 3, and that's going to be the ATR, that's going to be you're going to lose a lot of money before you finally get stopped out. You can see here earlier in the year that if you used ATR, you're talking about a lot lower ATR, because in 2017, volatility was extremely low. Okay, so that's why this number is so low. It wasn't until late January, early February of 2018 that markets became so volatile, and you can see that ATR spiked up. In other words, what this is telling you is that the average range of this particular security over a period of the trailing 14 days has been increasing. All right. I don't use ATR to calculate stops. Some people do. All right. I'm just saying that's how some people use ATR. Now, how I do use ATR is as a measure of increasing volatility. So if I were looking at, a 15-minute chart, I might say, okay, relative to prior days, like here, ATR is very, very low. So if I decide to trade the mini Dow, I'm probably going to get whipsawed a lot because it's very, very range bound, as you can see by the Bollinger Bands confirming that. I might not want to trade it until I start to see a sharp increase in ATR, which occurred right here. And just because ATR is going up doesn't mean price is going up. It just means the range at which it trades is going up. So you can see that here, an increase in ATR was related to or associated with a decrease in the price of that particular security. So one way that I do find ATR valuable for me is noticing if there is a convergence or divergence of ATR to price direction. So one of the things that was interesting on days when the S&P and the Dow and all the other indices had a very strong down day was if you take a look back on that day, generally speaking, you saw that increases in ATR tended to coincide with strong downdrafts in price. On the other hand, there were other days where you saw that strong increases in ATR tended to coincide with strong increases in price. So that's going to change from day to day, from period to period, but that is something that can be useful. If you look back over your trading day, and let's use a 4-minute chart here, and let's look at a particular day, which is from here to here. Okay, on this particular day in question, if I'm looking back over the course of this day, I'm seeing that there wasn't really dramatic increases in ATR, but here an increase in ATR tended to coincide with decreases in price. So here, strong increase in ATR, price was continuing to go down, and then as ATR started to decrease, that's when you started to see a reversal, an increase in price. So how can you use this practically? Well, in this particular example that I gave you, you could then, if you're looking back over the history of price action on that particular day, and again, nothing's true 100% of the time, remember that, and this is just past, it's not a predictor, but I could take a look over this history and I could say, okay, I'm noticing a correlation between increases in ATR and negative price action. So when ATR increases, I'm going to short the security, and when ATR starts, and I'm going to stay in that short position until ATR starts to decrease, and that's my signal to get out. And you can see that that strategy could have served you well here because ATR increased, and as it did, price action declined, and it continued up, or it went up here, but that price started to decrease to the downside, and then we see this little reversal in ATR, and now we see a more sustained move up, but it started to move down here, and this was related to not choppiness in price action, just choppiness in the ATR. So you might want to take a look at ATR over more than one time frame to try to figure out what is going on. But here we can see we're seeing consistency in ATR, which is leading up to a very strong downdraft in price, and that very strong downdraft in price continued until ATR started to decrease and confirm that it was going to continue moving to the downside. So you can see here that even though price is increasing, the range of that price is decreasing, and therefore you could use that as a signal that, all right, it's time for me to get out of this position. Now, depending on your trading style, you might give back some of your profit, all right, but that's okay. You don't need to capture 100% of the profit, just as long as you don't give back all of your profit or the majority of your profit, because you have to cut your losses early, keep your losses small, and let your winners run. So this is an example of how you could have used ATR to identify this as a, I'm short this security, so I believe it's a winner that's going to continue to run. A winner from the standpoint of, if I'm short, it's going to lose price, and I'm going to continue staying short for as long as ATR either stays at that level or increases, because as it increased, the downside momentum increased as well. But then once ATR kind of leveled off and then started to reverse, that could have been used as a signal to get out of my short position. Okay. So kind of a lengthy discussion, but that is one way that you could use ATR, either by itself or in conjunction with other indicators, as either an entry signal, to identify a possible opportunity, or as a signal to enter a trade, or as a signal to get out of a trade, because trend is, there's a reversal in trend here. So that's pretty much it for volatility indicators. Again, we have Bollinger Bands, there's a moving average, there's a boundary on either side of it. As Bollinger Bands widen, that tells you that there's increased volatility, increased price movement. That increased volatility tends to correspond with strong momentum, either up or down, depending upon where you are in the chart. On ATR, the basics are, this is a plot of the average range of price, and you also want to take a look at correlations between the average true range and the direction of the price that the price action takes, because that can tell you if there are strong trends forming that are about to begin, or it can tell you if those trends are starting to slow down or even reversing. Okay, there is no overbought or oversold level associated with ATR, because this is a direct calculation of the price level of the security. So it wouldn't be very meaningful to have an overbought or oversold level, because this number is going to differ. I mean, you saw it's 38 points here on the mini Dow, but on the copper futures it was measured in thousandths of a point. All right. So to summarize the discussion about technical indicators, and this is technical indicators in general, right? Technical indicators use some combination of price, volume, and time to provide you with some kind of visual representation on a chart that is therefore used to make decisions about trades. So when to get in a trade, when to get out of a trade, when to consider getting into a trade or when to consider getting out of a trade. All right. There are moving averages, there are momentum indicators, there are market profile indicators, and there are volatility indicators. Those are the four main categories, and I'm sure I've left something out. Again, like I said, there's hundreds of different technical indicators out there. What I've gone over are some of those most popular. Another important point that I'll emphasize is that there is no such thing as a perfect indicator, and believe me, I've searched for one and I have not found it. Most traders use more than one indicator to make their trading decisions. So they might use one indicator to give them the heads up that this security may be trending up or down, or coming out of an area of consolidation to trend up or down, and then use some other indicator to confirm that suspicion. I sometimes use multiple time frames as my confirming factor. So in other words, I might be using one indicator or one combination of indicators, but my confirmation is coming from another time frame. So if I'm looking at a 15-minute chart, I might look at my 5-minute chart to give me some kind of confirming comfort level, or I might even look at a longer time frame to give me some kind of confirming comfort level, because that is telling me, you know, this is what things are looking like in the bigger picture. All right. Indicators do not predict anything, because again, indicators are calculated using data that occurred in the past. So you can't use the information from the past to predict anything. You know, that reminds me of that, you know, saying that, you know, history doesn't repeat itself, but it rhymes oftentimes. And that's true also of technical indicators. You know, they don't predict anything, but they can be used to project probability and to identify trading setups that have a high probability of moving in the direction that they seem to be indicating, so that you can place and close out of a profitable trade. You need technical indicators to provide you with entry and exit signals, and there's the possibility that you might use one type of indicator for your entry signal and a different type of indicator for your exit signal, or some component of that indicator. I talked about on the stochastics, you know, I might use my fast indicator as an entry signal, but then use my slow indicator as an exit signal. You know, this is not a recommendation. This is just, you know, I've said this is what works for me, but I'm citing that as an example of how you might use different indicators or different components of indicators to comprise your overall trading system or overall trading strategy. So that's it for, you know, this video surveying the different technical indicators that are out there, and, you know, what they are and how you use them. Please leave comments on the page of this video. If you have any questions, you know, please please leave them or put them in the comment section. If you have ideas for other educational videos that you would like to see, leave those in the comments section as well. So please subscribe to my channel, and also check out the playlists. I've got a playlist of live trading streams where you're seeing my real-time trades occurring during the day. I also have playlists of archived Traders Espresso, which is the video version of my written blog that comes out at least once a day, sometimes twice a day, and sometimes on weekends, which is basically a summary of the previous day's market action and the day to come. You know, whether it's, you know, headlines to watch out for, or economic data to watch out for, or just things that you need to know to be well prepared for your trading day. So thanks for tuning in, and see you in the next video.